Welcome back to the channel. Today, we are tackling a question that completely changes how you look at building wealth. What if you only ever bought one investment? What is the best single ETF strategy at every single level of wealth? I am talking about a strategy so simple that you log into your brokerage account, buy one ticker symbol, and log out. No rebalancing spreadsheets, no agonizing over international versus domestic stock weights, and no trying to time the market. The financial services industry makes billions of dollars a year by convincing you that investing is a highly complex puzzle that only professionals can solve. But decades of empirical research prove the exact opposite. Simplicity is actually the ultimate sophistication when it comes to investing. However, the one ETF you buy when you have $5,000 to your name might not be the exact same one you want when you have $5 million. Your goals change, your risk tolerance changes, and your tax situation absolutely changes. Before we dive into the specific wealth tiers and the exact ticker symbols, I need to explicitly state the assumptions I am making for these hypothetical scenarios. For the purposes of this video, I am assuming you are a US-based investor, buying and holding in standard taxable or tax-advantaged accounts, with a long-term time horizon of at least 10 to 20 years. All historical return numbers we discuss today are hypothetical benchmarks, usually assuming a long-term average annual return of around 7 to 10%. Though, as we know, past performance is absolutely no guaranteed future results. And of course, I am an educator on YouTube, not your personal financial advisor. Always consider your own unique financial situation. Let us start with Tier 1, the accumulation phase. This is for net worths between $0 and $100,000. At this stage, your absolute biggest advantage is time, and your biggest enemy is complexity. The academic research on asset allocation from institutions like Morningstar and Vanguard tells us that for investors with long time horizons, equities or stocks have the highest growth potential among all core asset classes. You do not need the drag of bonds right now. For this wealth level, the undeniable king of the single ETF strategy is VU, the Vanguard S&P 500 ETF, or VTI, the Vanguard Total Stock Market ETF. Let us look at the actual numbers. VUU has a total expense ratio of just 0.03%. That means for every $10,000 you invest, you are paying Vanguard exactly $3 a year to manage it. Over the last 16 years since its inception in 2010, VU has annualized roughly around 13 to 14%. VTI gives you a very similar return profile, but adds in mid and small cap US companies, capturing nearly 100% of the investable U.S. equity market. Why do we stick to just one U.S. equity fund here? Because when you are starting out, your savings rate matters infinitely more than your investment returns. If you have $10,000 invested, a phenomenal 10% return gives you $1,000 for the year. But picking up an extra shift at work, starting a side hustle, or aggressively cutting your expenses could easily net you an extra $5,000 to invest. Your cognitive energy should be heavily weighted toward increasing your income and your savings rate, not managing a complicated portfolio of 6 different funds. You buy VTI or VUO. You set it to automatically reinvest the dividends. You let the compound interest machine start its engines. It is mathematically the most sound approach for building your first 100 grand. Now we move to Tier 2, the expansion phase. This is for wealth between $100,000 and $500,000. Congratulations, you have crossed the 6-figure mark. The snowball is finally rolling and gaining serious momentum. But you will notice something changes here. The daily fluctuations in your portfolio are now matching or exceeding your monthly paycheck. A 1% drop on a $400,000 portfolio is $4,000. That can really mess with your psychology. At this level, you still need massive growth, but academic research suggests you should start broadening your risk profile. The U.S. stock market currently makes up roughly 60% of the global market weight. But what about the other 40%? If the U.S. experiences a lost decade, like it did from the year 2000 to 2009, where the S&P 500 basically went nowhere, having 100% of your money in U.S. stocks can be psychologically devastating and lead to poor decision-making. The single ETF solution for this tier is VT, the Vanguard Total World Stock ETF. By buying VT, you are essentially buying a tiny fractional slice of every publicly traded company on planet Earth. You get the massive U.S. tech giants, but you also get European pharmaceutical companies, Japanese automakers, and emerging market banks. The expense ratio is slightly higher than VO, sitting at 0.07%, but you are getting over 9,000 individual stocks wrapped up in one single, incredibly liquid ticker symbol. When we look at recent historical performance, VT has trailed VOO over the massive U.S. bull run of the 2010s. VT has averaged roughly 9 to 10% annualized, compared to VO's 13%. But remember, asset classes are deeply cyclical. International stocks outperformed U.S. stocks in the 1970s, the 1980s, and the 2000s. By moving to a global ETF at this wealth level, you are buying the ultimate sleep-at-night insurance. You no longer have to care which country is dominating the global economy next decade. You own them all. Next is Tier 3, the wealth preservation and transition phase. We are talking $500,000 to $1.5 million. This is where the math of your entire financial life starts changing. You are likely older, perhaps within a decade of retirement, or you simply have enough capital that sequence of return risk becomes a very real mathematical threat. If you are 2 years away from retiring and the stock market drops 35%, an all-equity portfolio could force you to keep working for another decade just to recover. Morningstar research on asset allocation shows that as your target withdrawal date approaches, introducing high-quality fixed income is non-negotiable for smoothing out volatility. But how do we do that if we are strictly committing to a single ETF strategy? The answer is the target date ETF, or an asset allocation ETF, like AOA, the iShares Core Aggressive Allocation ETF. AOA holds exactly 80% global equities and 20% global bonds. It handles all the rebalancing for you entirely behind the scenes. When stocks crash, AOA automatically sells bonds and buys stocks while they are cheap. When stocks soar, it trims the winners and buys bonds to lock in those gains. Even better for this tier are the iShares LifePath Target Date ETFs. Morningstar recently awarded these the only gold rating for allocation ETFs. If you plan to retire in the year 2040, you just buy the 2040 Target Date ETF. Today, it might be heavily invested in global stocks for growth. But every single year, as you get closer to 2040, the fund automatically shifts its internal allocation, slightly reducing stock exposure and increasing bonds. By the time you hit your target year, the portfolio is mathematically optimized to protect your wealth against massive drawdowns while still providing enough growth to outpace inflation. It is the absolute ultimate set-and-forget vehicle for a 7-figure portfolio. Finally, we arrive at Tier 4, high net worth, $1.5 million and well beyond. At this stage, you have essentially won the game. Your focus shifts from simply accumulating wealth to tax optimization, estate planning, and generational wealth transfer. So, can you still use a single ETF strategy here? Yes, but with a massive caveat based on your account type. In tax-advantaged accounts like a Roth IRA or an employer 401k, a target date ETF remains a brilliant, hands-off strategy. But in a standard taxable brokerage account, multi-asset ETFs like AOA or target date ETFs can drag you down with severe tax inefficiencies. They are constantly rebalancing internally, generating capital gains and throwing off ordinary income from bond yields. That income is taxed at your marginal tax rate, which at this wealth level is probably very high. So, if you insist on the ultimate single ETF for a taxable account at the multi-million-dollar level, we actually revert all the way back to the beginning, VTI or VU. Why? Because broad market U.S. equity index funds are incredibly tax efficient. They rarely sell their underlying holdings, meaning they distribute almost zero capital gains. They only pay out qualified dividends, which are taxed at much lower favorable capital gains rates. At this top tier, your single ETF strategy is to hold VTI in your taxable account forever. You let it compound, you never sell, and you either borrow against it if you need cash, or you simply let the step up in basis at death pass it on to your heirs completely tax-free under current tax laws. To manage your risk and cash flow needs, you would hold your bonds or treasury inflation-protected securities over in your tax-sheltered accounts. But if we are strictly talking about the taxable side, you loop right back to the simplest, cheapest equity index fund you can buy. Let us quickly summarize the wealth progression. 0 to 100,000 or VTI. You want maximum growth, rock bottom fees, and you need to keep it incredibly simple while you focus your energy on earning more money in your career. 100,000 to 500,000, VT. Broaden your horizons, own the entire global stock market, and protect yourself from a single country's economic stagnation. 500,000 to 1.5 million, a target date ETF or a fixed allocation ETF like AOA. Start protecting your capital by automatically introducing fixed income into the mix as you near financial independence. 1.5 million and beyond. VTI in a taxable account. You are prioritizing ultimate tax efficiency, long-term compounding, and smart estate planning. The entire financial industry spends billions of dollars on slick marketing to convince you that investing needs to be complicated. They want you to think you need active managers, expensive hedge funds, private equity, and complex derivatives to build real, lasting wealth. But empirical academic research proves over and over again that passive, low-cost, broadly diversified index funds beat the vast majority of active managers over a full market cycle. You can literally automate your way to millions of dollars with one single ticker symbol. It does not require a finance degree. It just takes time, discipline, and the patience to let the math do the heavy lifting for you. Thank you so much for watching. If you found value in this breakdown, hit the like button, subscribe to the channel, and let me know in the comments which single ETF you would choose if you could only hold one for the rest of your life. I will see you in the next one.